So much. We get started with the session that not sure if AI would be able to answer a lot of questions here about materiality. It seems to be a big thing. A lot of questions about whether what's material, what's not material. So just a few the GFOA and CalCP have been looking at materiality, and just want to go over. I'm just going over the thing. I think this is.
China.
Is this the pointer?
Yeah.
Oh, wow.
Got it?
Yeah. So essentially the idea is changing the mindset and taking control of the financial reporting process. Okay. So we'll go over what materiality is, challenges, why revisit materiality and why take a look at it as part of your accounting process. We'll go over the CalCPA, CCMA white paper on materiality, 2 case studies if we have time. Otherwise, we'll probably stick to 1 case study. The materials essentially are available, so but I'll try to get to that. And then we'll go over a few questions and answers that are in the white paper if we have time. Otherwise, the questions and answers are in the white paper as well. And then if there are any other questions, I'll try to prioritize other questions from the group, since the other ones are available in the white paper itself. So what is materiality? So there's really no formal, I guess, written standard on materiality as far as local government is concerned. The concept is the information, is it considered material if its omission or misstatement could influence economic decisions of users taken on the basis of the financial statements. So would it really make a difference? And who are the users of the financial statements? I was talking with another client, talking about what variances need explanation in the budget to actual analysis now with GASB 103. And essentially, they were looking for a black and white answer, but there's no black and white answer. Unfortunately, it depends on who are the users. And then it's a question of, well, who are the users? So it takes it's not necessarily, it seems simple, but it may not be. Judgment is necessary. We'll talk about that. You may have different materialities for different disclosures, different funds. Also, you may need a different materiality for a different account. For example, you wouldn't look at cash the same as you would infrastructure. Challenges with judgment. So my opinion on what's materiality would be different from yours, and so forth. So as far as when you're looking at materiality, there are 2 approaches. There's a cautious approach, conservative, try to be as precise as possible. Everything is material. But what is that? There are consequences of that. The consequences are increasing the risks of false positives, treating something as material that would not affect the judgment of most reasonable users, right? So what would that create? Delaying producing financial statements, additional staff time, inclusion of immaterial items can actually hide what really matters. Say you have a lease liability and you have 100 leases and only 20 of them are really significant, but you decide to put all 100 in the note disclosures. It may give the reader the wrong impression as far as how many leases do you really have that are significant. So sometimes just including things for the sake of including them actually may mislead the reader.
Sorry.
Right, and then the other approach, of course, is the selective approach where you would maybe disregard a lot of items that you believe are immaterial, but that increases the risk of false negatives. And the impact of that is inaccurate financial reporting, obviously, and auditor adjusting entries, or worse, a modified opinion, an adverse opinion, issues with transparency, and so forth, the things that you deal with in local government. So as far as the GFA looked at a sample of ACFRs, and essentially they came to the conclusion that governments seem to take a more cautious approach than the selective approach. Just, you could say, maybe a better of the two negatives. So I rethink materiality. It's going to save us time. It's going to result in looking at a more efficient closing process, precision versus accuracy. A number becomes more precise as it becomes more exact. A number is accurate, essentially, if it helps you achieve your financial reporting goals. Here's an example of a precise number versus an accurate number, right? You wouldn't necessarily say that this number is necessarily more accurate than this number, maybe more precise. But as far as what's the difference, the usefulness is the same. And then that helps you with your decision making, just having more timely financial statements. Also, you need to look at opportunity cost. The time spent of someone trying to make the number more precise, their time could have been spent doing something else, maybe helping you, essentially get your financial statements out, reviewing note disclosures, doing something else as part of your closing process. And this is a chart here, just looking at two different lines. This is looking at certainty or preciseness. This is looking at value or cost. So you can see here, as you're trying to be more precise, the value of that information essentially decreases, or the delta decreases as you try to make things more precise. And here is looking at the cost of that decision. And you can see that incrementally, as you try to get more and more precise, the cost of that goes up. So you want to be somewhere in the middle here, depending on what your financial statements look like, where you essentially meet both objectives and not provide that value of information at a affordable cost. Here are some examples of things we've noted in various audits. Capitalizing and tracking small pieces of equipment. Obviously, no one's really tracking a golf ball. That would be ridiculous. But looking at laptops or things that are being capitalized maybe for operational purposes, but as far as what they contribute to the financial statements is minimal. Immaterial lease liabilities as a result of implementing GASB Statement 87. And that's what the white paper is really focused on, this implementation of new accounting pronouncements. Because you do feel the pressure of, well, I do have leases, I should record a liability. But if you have a copier and the liability is going to be $10,000 and your balance sheet has total liability of $100 million liabilities, and you really want to spend the whole week figuring out that $10,000. Accrual of an expenditure, for example, something as minor as that, of $1,000 for some invoice, when your total accounts payable exceeds $500,000. Moving to 25 minutes. So I might go a bit quick here. So this is the white paper. It's available online from the Cal CPA CCMA website. I believe the CSMFO, just as I was finalizing my presentation, they just happened to send an email notifying everybody that it's out there. This is a good timing. But it essentially introduces the concept of materiality, how to use it and leverage it in your organization. Also looks at statement evaluation as far as new accounting pronouncements that are coming up. I don't think, as far as you probably apply it to GASB statement 103, kind of went over subsequent events in the future. Going concern may not necessarily applicable too directly, but I'm sure there are other things that GASB will come up with in the future years. Encourages discussion with auditors. So as I mentioned, materiality is very subjective. What we say is material, what you think is material, we may get into a disagreement there. So it kind of advises how you deal with your auditors as you implement this. And the overall objective is to reduce workload on staff time and have timelier financial reporting. Not even issuing your statements by December, maybe earlier than December even. Right? These are the white paper, who were involved, and I had limitation of how many slides I could include here for 45 minutes. But there were various auditors as part of the panel that worked on this white paper. There are also a lot of people from your side of the fence, who actually work on closing, and these are the challenges. So there's a lot of complexity and a lot of work that takes in implementing your accounting standards. Evidence that materiality is not consistently applied. So sometimes you look in one area like accounts payable, and everything small is being accrued, and you look at a different area and something significant is not being recorded because they think it's immaterial. So I'm like, how can that be the case when you're looking at one account here? It has to be something that's kind of consistently applied to all accounts. I think this is very so every GASB statement has materiality language included in it, and this is what it says. The provisions of the statement need not be applied to immaterial items. So we'll talk about that more. But as far as getting started, how do you when you have a new accounting pronouncement and coming up with materiality, you need to know your reporting structure. So you need to know what reports do you need to issue. So I know a lot of you have a separate compliance report, financial statements for Measure B, a child care program, TDA, so forth. Your ACFR or your basic financial statements have various opinion units. We call them opinion units. They're really just reporting units, which are your governmental activities, business type activities, major funds. And then you also need to look internally. If you have any internal purposes or internal reporting that you're looking out. There may be other things that you need to consider, such as your internal financial reports. Maybe you need to submit reports to the state controller. Maybe you have information that may be material for rate studies or other purposes. So as far as what's material, the financial statements and our audit and other audits are one aspect, but maybe there are other reporting objectives that you need to consider when you're coming up with a materiality threshold or deciding whether you want to implement an accounting standard. Right. When you get a new accounting pronouncement, you want to take a look at it. We will help assist definitely, but we always look for management to review the accounting statement themselves. So you want to identify what is the purpose and objective of that statement. Why did GASB come up with it, and what does it address? What is the effective date? What is the scope of that pronouncement? So what transactions or entities may be impacted? And then also identify what were the key changes from previous standards. Why do this? This will help you understand that statement and essentially identify and what you need to do to plan for that implementation, and also develop some kind of implementation strategy. Why not just rely on us? The auditor will come tell us what to do, and then we're done with it. If I spend, isn't that what we're paying them for? It's not necessarily useful. But at the end of the day, responsibility lies with management. Management is responsible for financial reporting. And to be honest, you will know more whether something is applicable to you or not versus us who show up for 4 weeks out of a whole year and expect us to know. And we will perform procedures to make sure that we capture that. But you've been there, you've been reviewing everything. You probably are in a better position to provide that information. Demonstrates competence and readiness. So you always puts an impression on us as the auditors with, we're like, hey, let's talk about new accounting pronouncements. And you're like, oh, you're talking about GASB 103? Oh yeah, we see blah, blah, blah. And that will automatically put us at ease versus we start the conversation and then say, well, talking about GASB 103. And you're like, oh, what's that? You're like, okay, we need to, maybe we need to do a lot more work than we were planning. It's going to help you timely implement that. It's going to make you plan for any operational changes. Also, it'll help you get information in advance. So if you need to go and look up lease agreements that are buried in a warehouse, that can be done months in advance or years in advance, versus trying to figure that out on the year of implementation. Advanced preparation also leads to more productive discussions with auditors. Okay, so once you've done and read through the statement, what's the next step? Is to perform some kind of assessment. Does this apply to my agency? What transactions are affected? Who must be involved and in evaluating and implementing it? Do you need to involve other departments? You may need to look at public works or police department. Do we need outside expertise? Do we need any kind of expert, like an actuary involved? Those are things that you can gather and answer once you've done that. So what does implementation mean when you say we implemented a new accounting pronouncement? So that begins with your understanding and deciding why they apply or do not apply to your agency. Some statements require ongoing evaluation, like leases, for example. You can't just say, well, we implemented GASB 87 and then we're done with it. And then all the while, every year, you've been getting into new lease transactions and you said, well, I implemented it, we're done. No, it's ongoing every year you have to. And there may be some that are just one time, but for the most part, it's an ongoing evaluation. We need to click on that. Consider the potential impact and whether it's material. That's significant. If the statement is not applicable or is considered to be immaterial, the statement is implemented. So as long as you can document that you've looked at it, you've understood it, you know what it means, you've kind of done an initial overview and made an analysis and said, well, this probably is not going to result in a material impact to my financial statements, that's sufficient to say that it's implemented. You don't need to go beyond that. Obviously, if it says it's material and applicable, then you need to do more work. But it's going to save you a lot of time versus trying to just go through the whole implementation without even looking at whether it's material. And then, of course, as I mentioned, you want to kind of continually review your assessment every year, maintain documentation, and then also look at materiality every year. Something that may not have been material before may be material now. Just here, listing out a few factors when you're looking at materiality. So, quantitative is kind of easier if people like quantitative. I like quantitative myself because it's very simple. So obviously looking at, percentage of total assets, a percentage of total revenues, a percent of total fund balance, establishing, well, 5% of these numbers, I'm going to go with that and say that's material. I like to look at quantitative materiality as kind of like a beginning guideline. Once you've looked at that guideline, look at the end result and then decide whether you ask that question of whether a reasonable user of the financial statements consider this to be misstated or not. And then, you may need to do a revision. Qualitative things to consider. Legal compliance, debt covenants, fraud risk, public interest, right? So as I mentioned, cash and investments, right? When we look at cash and investments, when we're auditing cash investments, we may have a materiality for the general fund for a significant large city of $500,000, say for example. But if we find a misstatement in cash for $300,000, we're not going to say, well, okay, immaterial, let's move on. We always kind of have to understand more. Obviously, if we understand that, oh, they just didn't book the unrealized gain or loss, and that's the reason why, and they don't really want to book it, then that's fine. But just not versus infrastructure, for example, we may have a higher materiality for infrastructure, where there is not really a large fraud concern about someone stealing your roads or so forth. Debt covenants are significant if recording $1,000 transaction is going to mean you met the covenant or didn't meet the covenant. I would say it's still material. You probably should record it and be honest or be transparent with it. And that's essentially the idea. Obviously, if the public, citizenry, or council are interested in certain things, you may look at that as more of something where you want to lower materiality versus, but this is just some examples. Yeah. Right, so applying materiality, so establishing thresholds, first thing, comparing it to the total impacted balance. It's kind of obvious. If below, document it's immaterial. If above, then identify transactions that are significant. Transactions that are trivial can be documented as immaterial, meaning that you may identify that your lease liability is a potentially material item. Once you go through the leases, I think I have an example here. I'll just maybe go to that one. So this is an example with leases. So you can see here that your lease liability is about 500,000. Your threshold is 100,000. So you can see here you have identified the different leases. So you can see this one by itself is over the threshold. So this one you automatically conclude, yes, you need to include this. These two are below the threshold, but combined in aggregate, they are material. So you want to consider those as well. And then you've kind of included out of this two, you'd have 450,000 out of 500,000. And then the remaining 50,000 is not material. So you can disregard those. You could ask me a question, well, I think I had a client ask me was, well, how do I know what those numbers are if I didn't really do the work, essentially? As far as I would have to kind of do a little bit of work to calculate what these liabilities are as part of my implementing of gas. Why don't I just carry forward and just go ahead and book the whole 500,000? Well, you have to every year you have to reassess those leases. If there are amendments, you have to record journal entries. So even if you've done the work to calculate the liability, by not recording them, you would offload a lot of work in future years. I think I missed one point on the previous slide. It was to communicate with auditors. So as part of implementing the new accounting pronouncement, and you're coming up with these dollar amounts, communicate with the auditors, and before year end, before your final audit, just so you get their sign off, quote unquote. There's always room for us to disagree at the end if things change, but if nothing changed and we already agreed ahead of time that yes, this is fine, then we're going to have a smooth year end. If we don't have that conversation before year end, you risk that we're going to disagree and you'll have to redo a lot of work that you may have been able to do in your slower time when there was less pressure, stress, so forth. All right. Educating leadership and elected officials. So this is important because, you communicate to them, they evaluate, they essentially may comment or disagree on things. So the more you educate them about the financial statements and about materiality, the more you're able to utilize it. So you can have finance and audit committee meetings as part of the presentation of the financial statements. Things can be communicated to them. I think this is an important item, explaining terminology, what's material, what are uncorrected misstatements. We'll talk about that a little bit more. 5 minutes. All right, I might need to go really fast here. All right, I just wanted to point out uncorrected misstatements. Uncorrected misstatements are not necessarily errors. They are just purposefully unrecorded items. They may be errors as well, but they are not necessarily immaterial. They're not material. But as part of the auditing standards, we have to communicate them to the governing body that these variances above a trivial threshold, were not recorded. So that does not mean that the financial statements are misstated. It does not impact our opinion. I've had a lot of clients where we had uncorrected misstatements, and then when I told them, well, this will be ending up on the SAS 114 letter, they decided, no, we want to record them. We don't want to have to explain to counsel and then have them accuse us of being lazy or some other negative thing, which is not necessarily the truth. The truth is, you've made a strategic decision to have timely financial reporting that, we can't necessarily record every single penny. It's not that we're being lazy. It's just that our objective is that we want to get to the information timely. So that requires communication and clarification. So that way we can take advantage of this. We'll go over this example with the city of Newport Beach. This is a good example. So they had 141 leases totaling 268 million. They initially capitalized all of them and amended them annually. In 2025, 50 of them needed amendments. We decided to take a look at it again. And they established a capitalization threshold for leases. So what they did is they did a Pareto analysis. And this is where you sort all your assets or whatever you're trying to analyze. You sort it from the lowest dollar amount to the highest dollar amount. And then you essentially analyze them and say, well, how much of the total population are in these different categories, right? So you can see here, over 1 million, that contributes to the majority of the items. The rest of them are quite small. So you can see here in the chart, this is how this red line essentially is reflects the cumulative percentage as you add up all these amounts. You can see they're adding, and then they look at this over 1 million, and boom, that's 90% of the population. So what they did was they also looked at they identified, well, 90% are over, and these leases over $1 million. If they looked at the ones below 300,000, that's only 2.4%. They also noted that leases are recorded in this major special revenue fund. The rest are in the general fund. So they first checked, they first decided, well, a threshold of 300,000 would be appropriate. However, because when you enter into a lease, you do have to record additional capital outlay, and you also have to record proceeds or the proceeds from debt issuance, or just debt issuance. But essentially, there is an impact on the governmental funds. So because the auditors had materiality, that was below 300,000, they essentially agreed on 200,000. And in conclusion, 51 leases were excluded. So essentially, that's 51 leases they didn't really have to worry about. They also you know, unfortunately, not unfortunately, but as part of it, they did have to include a communication of uncorrected misstatements in the SAS 114 letter, just meaning that the amount that they're excluding is not necessarily a trivial number. It is a number. As part of auditing standards, when you're auditing, you may find a misstatement that's below a materiality threshold, say, for example, in receivables. Then we find another misstatement below our threshold in prepaids. And then we find another misstatement in cash. Those in total, when we aggregate them, may result in a material misstatement. So which is why we track these variances over this trivial threshold. So that's why they require communication. But essentially, this was discussed with the city, and they agreed. They saved, they estimated savings in hours, about 40 to 50 hours of staff time in making this decision. And this is what the communication looks like. So you can say the city applied this. This amount was not recorded. These amounts were not considered material to the financial statements. That's it. And then as far as how this is disclosed, it may vary from firm to firm, but it may be narrative form, it may journal entry form, but that's the end of it. There's no opinion, it's still a clean opinion, and everyone moves forward. Let's try to squeeze in maybe one more example here, since capital asset seems to be a very popular topic and capitalization thresholds. So this is an example from the GFOA looking at Sweetgrass County, and nice name for county. They had a $5,000 capitalization threshold that hadn't been changed for a very long time. Eventually, the finance director looked at it and says, why are we capitalizing a $6,000 asset, this and that? It doesn't really add a lot of value to the financial statements. And they did a similar analysis, and this is another way to look at the Pareto analysis, where you're adding up all the assets from smallest to largest and seeing how they contribute. So this red line represents an even distribution, and this is the actual distribution. So the bigger the dip means that there's probably a lot more benefit. If this line was more parallel to this, then maybe it wouldn't be worth it to change the threshold. But essentially, you can see here that the larger assets are actually contributing more of the total value than these smaller assets. And then this is their updated capital assets policy. You can see that they kind of segregate to the different types of capital assets, the different thresholds. And what the results were many low value assets were removed. Policies were set for thresholds for tracking and count capitalization. The upfront time was a lot, but then this will save time in the future. So there's some key lessons: materiality is judgment, not a fixed factor. Data can guide thresholds, so auditors validate, but local context decides. One thing I forgot to mention is they actually also checked with the board before making any updates to their policy, so the board signed off on the change first. And I think one of the items, materiality decisions should not negatively impact the ability of user decision making. So as far as setting your threshold, you also don't want to set it too high. I think as we mentioned earlier on a different topic, you also want to still set it appropriately. Okay. All right. I think that's it. I think we should probably conclude and go for break. And then
Sure.
These are questions and answers. They're written in the white paper. They're also in the presentation. There's really not much to it. I think otherwise, this is just some other resources available from the GFOA and the Cal CPA. And if there's time, I'll take questions, but I'll take questions during the break. But otherwise, I think we're good for some some snacks and coffee and drinks. All right, thanks so much.